Imagine you've just spent $20,000 fixing up your rental in its first year, and you're already picturing that $20,000 deduction on your return. Here's the part that catches people off guard. You probably won't get it. The ATO has a quiet rule called initial repairs that can stretch that fix into $500 a year for 40 years. If this is news to you, that's not a failure on your part. Most people are never told this rule even exists, and even some builders get it wrong. But here's the good news. Once you understand it, you can work with it. Today, I'll walk you through 3 simple moves: auditing your spending, itemizing your invoices, and building a capital work schedule so you keep every dollar you're genuinely entitled to. Here's the number that drives everything you're about to learn: 2.5%. That's the ATO's capital works deduction rate, and it applies per year over 40 years. ATO Capital Expenses Guidance. When work gets classified this way, instead of deducting it now, you're claiming a tiny slice each year for 4 decades. Understanding this one figure changes how you approach every dollar you spend on your rental. So let's map out your 3 moves. First, you audit your repairs against the ATO's own definitions. Second, you itemize every invoice so repairs and upgrades are clearly separated. And third, you build a capital work schedule before you lodge. Each one takes under 30 minutes and uses free ATO tools, and here's where it gets genuinely useful. Let me show you how this actually works, because the mechanism matters. The ATO treats repairs and maintenance as work that fixes wear and tear or damage that happened while your property was rented out. ATO Repair and Maintenance Guidance. But any work that fixes damage, defects, or deterioration that existed when you bought the place is an initial repair, and that's capital, not something you can deduct straight away. And here's where it hits your return. If you spend $20,000 fixing genuine damage that occurred during the rental, the full $20,000 is deductible that year, ATO. But if that same $20,000 is classified as initial repairs, you get $500 a year for 40 years, ATO Capital Works Rate. There's even a sting in the tail. The ATO reduces your CGT cost base by what you claim, which lifts your tax when you eventually sell. But hold on, because there's a second trap coming that catches even more people. The second layer is what advisors call the betterment trap. The ATO treats capital improvements differently from repairs. Anything that increases value, extends the property's life, or adapts it to a new use lands in capital works. ATO TR 97-23. Remodeling a bathroom, adding a pergola, or swapping a damaged item for a significantly upgraded version all get pushed into that slow 40-year lane, even when it feels like you're just fixing things. Picture a $30,000 bathroom and kitchen job. If it's itemized and clearly repair only, the full $30,000 could be deductible that year, ATO. But if it modernizes those rooms, which it usually does, it becomes capital works at $750 a year over 40 years, ATO. And here's the one that really stings. If your invoice mixes repairs with upgrades and you can't separate them, the ATO can treat the whole lot as capital. Keep that in mind, because it becomes the difference between a big deduction and almost none. Now let's bust the myth that trips up most landlords. Most people believe that if they spend money fixing their rental, it's automatically a repair and fully deductible this year. It's not. The ATO only allows immediate deductions for damage that happened while renting. Pre-existing defects and improvements are capital, written off at just 2.5% a year over up to 40 years. ATO. Knowing which bucket your spend falls into is where the real money is. Let me put both costs together with a real example and run the numbers 3 ways so you can see yourself in them. On $50,000 of spend, someone on a lower marginal rate, say 21%, expected around $10,500 back in year 1. Someone in the middle at 34.5% expected about $17,250, modeled ATO rates, and a higher earner at 45% expected over $22,000. What each of them actually gets in year 1? Just a few $100s. Here's the part nobody tells you, that gap compounds across decades, and your CGT bill climbs too. Let me introduce you to Lisa, because her story probably rhymes with yours. She's 42. A marketing manager earning $120,000 a year. She bought an older inner suburban unit for $750,000, rents it out for about $32,000 a year, and spent $50,000 on work in her first year of owning it. Exactly the kind of spend you might be planning. Here's what she found. First discovery. Lisa spent $25,000 fixing structural defects that were already there when she bought: a leaking roof, a rotten balcony, unsafe wiring. She fully expected a $25,000 deduction, ATO. Instead, because those defects predated her ownership, their initial repairs at $625 a year, around $215 of tax relief, not the $8,500 she was counting on. And if that's you right now, don't panic, there's a way to handle it that I'll come to. Second discovery, and this one's easy to fall into. She spent $20,000 on a rundown bathroom, new tiles, a new vanity, a slightly changed layout. Because that work improves the bathroom and extends its life, it's a capital improvement at $500 a year over 40 years, ATO. She'd expected the full $20,000 deduction because the builder casually called it a repair, a wording slip that cost her roughly $6,400 in relief that year. The third discovery is the one that stings most, and it's completely avoidable. Lisa also fixed genuine tenant-caused damage, a broken window and flood-damaged carpet, which is immediately deductible, ATO, but the builder issued one combined invoice for $5,000 covering both repairs and improvements. Because she couldn't separate the two, the ATO's position is that the genuine repair gets dragged into capital, just $125 a year. One invoice did that. Add it all up, and here's Lisa's year one picture. She expected about $17,250 in tax relief and received only around $431, modeled at 34.5% ATO Capital Works rules. That's a year one shortfall of nearly $17,000 on work she genuinely believed was deductible. I want to be honest with you, you can't always avoid every dollar of this because some spend genuinely is capital, but you can make sure you never lose relief you were actually entitled to, and that's what the next part is about. So let's check, could this be you? Sign 1, you fixed defects in the first year of owning your rental. Sign 2, you upgraded or modernized rather than just restoring. Sign 3, you've got one combined invoice mixing repairs and improvements. If any of those ring true, your repair claim could be at risk, but knowing that now, before you lodge, is exactly the advantage you need. Now let's turn this around with 3 concrete moves. These aren't theory. Done properly, they keep your genuine repairs deductible this year and make sure your capital works are claimed at the right rate instead of quietly disappearing. Each one takes well under half an hour, and they all use free ATO tools you already have access to. Move 1. Audit your repairs. Log into MyGov, open ATO online services, and pull up your rental schedule from last year. Go through every entry labeled repairs and maintenance and cross-check it against the ATO's definitions. If something fixed a pre-existing defect or improved the property, it belongs in capital works, not in your immediate deductions. This is where most of the overclaiming risk hides. Here's exactly how to do it. Open your rental schedule in ATO online services, flag any defect that existed when you bought the place, and move every initial repair and upgrade into the capital works category. What good looks like? Only genuine wear and tear that happened while renting stays in your repairs claim, and everything else sits where the ATO expects it. Move 2. Itemize every invoice. For any big job like a bathroom, kitchen, or roof, ask your tradesperson for an itemized invoice that clearly splits the repair work from the upgrade. The ATO only lets you claim the repair portion if you can separate it out, otherwise the whole amount risks being treated as capital. This one habit alone can save you thousands. Here's exactly how. Ask for itemized invoices showing the repair versus upgrade components, mark anything that restores rental period damage as a repair, and store those records with your tax documents. What good looks like. Every project has a clear dollar split you can confidently defend if the ATO ever reviews your return. Move 3. Build a capital works schedule before you lodge. List every structural improvement and initial repair you've made since purchase. Apply the correct rate, usually 2.5% over 40 years, and note the start year for each item. For larger properties, a quantity surveyor report makes sure you don't leave legitimate deductions on the table, and this is where it can genuinely tip back in your favor. Here's exactly how. List all your structural fixes and initial repairs since buying. Apply 2.5% over 40 years and record each start year. Then enter repairs and capital works in the correct ATO boxes. What good looks like. Every capital item claimed at the right annual rate, nothing overclaimed, and just as importantly, nothing underclaimed either. You might be wondering how set in stone this all is, and the answer is very. The capital works regime began back in 1985, covering property built or improved after the 17th of July that year, ATO. In 1997, the Commissioner issued ruling TR 9723, drawing the line between repairs, maintenance and improvements. TR 9723. And the ATO keeps refreshing its residential rental guidance today. This isn't a loophole they might close. It's a decades-old line they actively check, so assume they'll look. After you've done the work, here's how you'll know it landed properly. You should see repairs and capital work sitting in separate boxes on your return. You'll be able to confirm every big invoice has a documented split between repair and upgrade, and if you're ever audited, you can show exactly when each defect or piece of damage arose. That's what a bulletproof rental claim looks like. Everything I've shown you comes straight from the ATO's own repair and maintenance and capital expenses pages, plus registered tax advisor commentary and ruling TR 97-23. All the links are in the description, so you can read the exact wording yourself before you lodge, and I'd genuinely encourage you to, because seeing it in the ATO's own words makes it stick. So, you now understand something most landlords never do: how the ATO quietly turns rental repairs into 40-year capital works, and the 3 moves that protect your deductions. Next week, I'm walking through the depreciation schedule most landlords never claim, which can be worth thousands a year, and it pairs perfectly with what you've just learned. If you've made it this far, you're already ahead of most rental owners heading into tax time. The single best next step is to log into ATO online services this week and review your rental schedule while it's fresh. It takes about 20 minutes. If you want to go deeper on getting every legitimate deduction, that's exactly what we cover next. I'm Sophie. I'll see you there.